Well, welcome everyone. My name is Steve Buchanan. I'm one of the founders of Mosaic Capital Partners. Mosaic Capital Partners is a manager of private equity funds. And what we have developed over the past 6 to 8 years, we think is a very unique strategy that we have brought to the lower middle market that allows owners of businesses, their advisors, their managers and their leaders and their employees an ability to meet all of their respective goals, while at the exact same time transitioning their companies into 100% employee ownership by using an employee stock ownership plan, an ESOP, to be the owner of the business going forward. We here at Mosaic are huge advocates for employee ownership. And what we think we found is a key to unlocking the ability to scale employee ownership across our country. We think it's a shame that more companies have not transitioned into employee ownership. And so we think we found a unique way to do that. To demonstrate that and highlight that for you and give the attendees an idea of what it's really like to execute one of these transactions, we have a little case study today, a recent Mosaic portfolio company investment. And the name of that company is New Source Financial. You'll be hearing from John Erpelding, who is relatively unique in that he is both a founder owner of New Source. He had gone through one transaction with traditional private equity, and yet still wanted to remain with his business in its next step of its evolution and its journey. And so John brings a very unique perspective as both a founder owner, someone who had sold and worked with private equity, and yet was going to take a third swing in the batter's box, and had never really considered what it would be like to be employee owned until we had the chance to interface with him. And then the second constituent you'll hear from is Doug Bolerman. Now, to make these transactions work, we at Mosaic not only need our own capital, but we need third-party lenders to come in and support our transactions. And Doug is a great example of that. Doug works for a large, highly sophisticated firm, and Doug and I will discuss sort of how he as a lender views Mosaic as a sponsor, while also views individual credits and the role that employee ownership can play in making them great targets for Doug and his firm to deploy capital. So we'll have a couple of interviews. I hope you find them interesting and informative, and then we'll wrap up at the end. Thank you. Well, it's my pleasure to welcome John Erpelding, who is the president and CEO of New Source Financial. New Source is a portfolio company of Mosaic Capital Partners, and so welcome, John. Thank you for joining us.
Thank you very much, Steve. I appreciate the opportunity.
I thought we might start by having John introduce himself, give the folks that are tuning in a little bit of his background, and then go into a somewhat of a detailed background about New Source Financial, the firm, its history, its products, services, target markets, geographic reach. Give the folks a feel for the size and scale and scope of New Source Financial.
Sure. Thanks, Steve. Yeah, again, John Erpelding, President, CEO of New Source Financial. I co-founded New Source back in 1999, and at that time, New Source was really serving the financial market, being banks and credit unions, strictly from an ATM standpoint, and we've expanded the business quite a bit since that time frame, and we're offering a lot of different products and services now to our customer base. Again, we're doing a lot with integration of ATMs, ITMs. We've also built out a full suite of high-end security solutions for our clientele, and our current customer base. We've got about 700 different clients, Steve, spread out across 18 states. And we really are pretty deep with a lot of those clients in terms of helping them really kind of manage the customer, the member experience, if you will, through self-service as well as integrated security technologies. And throughout that 18-state footprint, we've got roughly 115 employees within the company, so pretty wide depth in terms of our service offering. We've got about 80 service trucks out there in our market, and about a dozen sales folks, and obviously a number of admin and other people to make this company successful.
Interesting. So, John is really interesting, folks, in that he is a very unique in that he's a founder owner. Two, he's gone through 2 transactions now with initially a private equity firm, and then a second transaction that gave us the opportunity to become his partner. And so John has a pretty unique journey as a leader, founder, entrepreneur, and partner with 2 different types of financial institutions. So I guess, John, first question, back when you did your first private equity deal, what were you trying to accomplish? What were you looking for in terms of a partner? Then I guess 4 or 5 years later, as always happens, your private equity partner just needed to sell your company, do what we describe as a change of control transaction. And what were you looking for then? And what was it about the Mosaic strategy and or employee ownership that appealed to you?
Yeah, so when we were looking at bringing on an investment partner back in 2015, what really drove us to private equity at that time was our need to continue to scale the business. We kind of reached a point, Steve, where we just, we continued to roll the capital back into the company, and we were doing very well and it was growing, but we just reached a critical mass point where we knew we had to infuse some additional capital in the business to really invest the way that we needed to invest to grow the company. And we had strategically rolled out some different types of programs for our clients, specifically around managed services, where oftentimes we were holding and owning a lot of those assets for our clients. So it became very capital intensive. So that was really back then what drove us to more of a traditional private equity model. And so, we did have your, historic, 5-year hold, almost 6-year hold, I guess, with that firm. Did extremely well through that period. And when it was time to take the company to market again, it was a pretty competitive arena. There was a number of companies or PE firms that were interested in the company, but what really stood out for us with Mosaic's model and the ESOP strategy was, we've been really, really focused as an organization for many years on culture and just making sure that we've got the right culture to deliver the right products and the right services to our customers. And so when we stepped back and kind of looked at the model and compared it to a more of a traditional PE position, I think that ESOP strategy really it really stood out from my perspective in terms of what we were trying to accomplish with just, that employee ownership, the strategic messaging we're trying to send in terms of really delivering, I would say, not only world class, but just a different approach with employee ownership, because that piece of the business for us has been extremely important, and I think it's enabled the company to really represent and have just a different brand and a different feel in the marketplace, because we do have, I think the employees have really bought in, and I think it's resonating with not only them but with our customer base. And so that has just kind of helped us build on, I think, years and years of significant investments in culture and just the right environment and what we're trying to do as an organization.
And so, when your prior PE owner decided to sell the company, they do what is not atypical. They hired what's referred to as an investment bank or a sell-side advisor. And then that advisor brought you and your previous owner a bunch of different options. Were there any other ESOP focused options that they uncovered?
No, there was not. Mosaic was the only ESOP strategy that we looked at, and again, that just kind of stood out for us based on what we're trying to do as a company, and it really kind of moved you guys, I would say, to the top of the field in terms of interest level from our perspective.
Yeah, I mentioned that. I made that question so our attendees could hear that answer. We at Mosaic know we're the only ones currently today sort of focused on companies of your size. And I would tell the attendees that we would describe John's company as a lower middle market size business, which we define as having, 5 to 12 million bucks of EBITDA. And today, unfortunately, I guess it's unfortunate that we're really the only folks in the marketplace offering great leaders like John an employee-owned option that will also work when they've got a seller who needs liquidity, who needs to sell their business in a cash transaction. You mentioned, John, that your employees have kind of bought in. I would say let the folks know that as we were working with John and his team, the culture aspect that John referenced was readily evident to us. If you think about, you've got 100 or 80 guys running around in trucks in 18 different states. How can them thinking like an employee owner help them become even better representatives of your company?
Yeah, it's becoming more and more apparent all the time because of the feedback that we're receiving from the team. I mean, they're questioning things, the way we're doing things. They're raising different ideas, and quite honestly, we're hearing it from our clients. We provide net promoter score surveys after every service experience with the customer, and our net promoter score is an 85, which is just that's almost unheard of. And so we're really, really proud of what our service teams are doing. I think that they are thinking of the business as, hey, this is my business, and we've incorporated this into pretty much every aspect of the business and how we run it. It's part of our talk track with our sales team. It's part of our talk track with the executive team. When we're out talking with new prospective clients, we're making sure they know that we're an ESOP company. And you know what, the guy or the gal that shows up to service their equipment in that van, that individual is also an employee owner. And that has resonated really, really well with our clientele base. And I think that they see the value in it. And so it's a special dynamic, I think, that we bring to the table. And I don't believe that there's another company in our industry that's an ESOP company. And it's just, that model works extremely well for us, especially considering, a big piece of those employees work 100% remotely. They don't have an office to come to. Some of them do report to headquarters or our office in Missouri or wherever, but more often than not, I mean, they're working completely independently. So having that employee ownership aspect of it, having that additional buy-in has been really impactful.
Yeah, it's interesting, John, that you talk about how transitioning into employee ownership can be used as a benefit and as a differentiator for your company in the marketplace. It allows you to say to your clients, the folks that are coming to do the work are not only employees, but they're owners. And we found that especially in businesses like yours, where you're a service business and your employees are interfacing with your clients on a daily basis, that differentiator is something that you can use to your benefit.
Absolutely, 100%.
So what would you say to someone who was sitting in your chair, the chair you were sitting in 2 years ago, almost exactly, right? What would you say to that entrepreneur or CEO as they are thinking about different options? What would you say about this employee ownership model that you guys pursued?
I would advise anybody to investigate it very heavily, because I think for a lot of businesses out there, this is a really good strategy. And especially for those businesses, like you said, Steve, in our case, heavily focused on service delivery, wanting to make sure you're sending that right message, really representing your brand the way you want to represent it. I think that this model really has a dramatic impact. And anytime that I think it's, for us, having that remote work group, especially, this has really kind of helped bring it back around and really kind of button everything up for us and tighten things up. And just to give you an example, I've always done quarterly updates for our entire company, and I'd say historically I'd get 75% of employees to join these calls. I don't force people on it. I don't make it mandatory, but
Yeah.
I'll tell you, I got one coming up next week, and I think almost 100% of my employees are going to be on it because they're looking at it differently, right? And so we are seeing that true buy-in, as I said, and it's really powerful, and everybody knows what happens when you get an entire group of people moving in the same direction. Good things happen. And so I think we're seeing that play out, and it's really been a lot of fun. And I just love, I got kind of a bit of a sales and marketing background, and I just love the ability to really talk differently than our competitors. And this really enables us to do that. And it's a different strategy, it's a different message. And it's been received really, really well in the marketplace for us.
Well, that's that participation by your workforce is really a great indicator that that you and your team have done a good job of communicating to them what it means to be an employee, what it can mean, the impact they can have, the value that they add, as you talked about, making suggestions that you might not have heard previously because they're thinking about the world in a different way. And all of those are indications of how you guys can make NewSource a better business, a more valuable business. And ultimately, all those improvements that you make are going to manifest themselves in value and wealth creation for your employees. So it's really, from our perspective, it really is a win-win situation for the company, for all of its constituents, and obviously for its employee owners.
I couldn't agree more. Absolutely.
Well, John, thanks for your time today. We really appreciate it. It's a pleasure and our privilege to be working with you. And we look forward to helping you continue to make NewSource a great business. Thanks a lot.
Thank you, Steve. Appreciate the invite.
Well, it's my pleasure to welcome Doug Bolerman to our discussion today. Doug is with a firm called Stellus, and they have been an active participant in multiple of our Mosaic transactions. And obviously, were one of our lenders in the transaction we completed with John Erpelding at NewSource. So maybe we'll start today. I'll let Doug introduce himself and give the attendees an idea of who Stellus is, what they do, what different credit products they offer. And then we can kind of go from there and talk about how and why they participated in our process in the transitioning of NewSource into an employee-owned company. So Doug, take it away.
Great. Thanks, Steve, and appreciate the opportunity to participate in the conversation today. So I'll give you a little bit of background on Stellus. So we are a private credit provider, so direct lending is the way to think about it. Stellus has been around as the current entity now for about 10 years, but the senior team goes back working together, for another, 10, 12 years past that. I joined at about 6 years ago to the team, and where we focus is working with sponsors, people like Mosaic, on leveraged buyouts of a variety of different types. We have about $2.8 billion under management right now. The team going back further has probably done transactions close to $8 billion in total over, kind of a 25-year period of time. And where we focus is on primarily, the unitranche or first lien aspect of transactions. So, for those who don't know, a unitranche is kind of a combined first lien, second lien product that's evolved over the last kind of 5 to 6 years in particular. So that's the bulk of probably 90% of the transactions we do. We also will look at, which we actually did here in the case of NewSource, a split lien transaction where we may work with a bank lender who does more of an ABL or an asset-based deal, and then we come in with a term loan behind that. We will also consider a structure called a first out, last out, which also involves a commercial bank. And occasionally we'll do, some second lien. Another piece of our strategy is that we do look to co-invest with our sponsors when possible. And I'd say at about 75% of our deals, including the transaction here for NewSource with Mosaic, we were able to participate, in this case, in the structured equity product, but kind of wherever the sponsor is coming in is where we like to participate. So that's kind of at a high level what we'd like to do. We really focus on the lower middle market. So this was a really good fit for our transaction, and excited to be part of NewSource.
Well, obviously, Doug, you and your team are really sophisticated credit providers. So you talked about a whole bunch of different kinds of products. In your transactions that you refer to as private equity sponsored or sponsored transactions, describe what they tend to look like and the role that you look to and count on your sponsors to play?
Yeah, absolutely. And the sponsor is without a doubt an important piece of our equation. When we're underwriting transactions, we certainly look at the credit, which is extremely important in what the business is and the business model. But I think there's sort of three factors for us that are very important. In addition to the credit, it is the sponsor itself. We view it very much as a partnership approach, that we want to work with sponsors that we think are knowledgeable in what they do, support their credits, all those types of things. And then the third piece of it, is management teams. I think we have a view, as I think a lot of our sponsors do, that if you don't have the right management team in place, it's really hard to be successful no matter what the business is. So that's, part of the philosophy about looking at, sponsor businesses. We like the lower middle market. Our sweet spot, I would say, is businesses that tend to be about 5 million to 25 million of EBITDA. So kind of right where, New Source fits into that category, where, the sponsors are coming in, often working with founder-owned types of businesses. And it's a very interactive process to help those businesses become, a little more commercialized, for lack of a better word. Frequently you have a management team that, has built an extremely good business, but is looking for a partner to help them out and take it to the next level, provide some liquidity to that guy who built it up and has his entire, career invested in that. So, once again, we think the sponsor is an extremely important part of the equation, along with the management team and who they're choosing to work with.
And so in our Mosaic transactions, they're kind of we think of them as being kind of a hybrid, or kind of a not a pure play, in that on the one hand, we as Mosaic have found the transaction, a company that is transitioning, and have given them an option to become an employee-owned business. But we're not a control investor like your sponsors typically are. It sounds like, Doug, that as a credit provider, as you take a step back and think of what's going to happen going forward and the role that you would expect Mosaic to play, it is not drastically different than the role you expect your traditional private equity sponsors to play.
Yeah, Steve, that's absolutely right. And, it's definitely Mosaic has a different approach. I think one of the things that's been helpful is, prior to coming to the New Source deal, we probably looked at, 4, 5, 6 transactions with your team. For a variety of reasons, we didn't end up being the lender in those deals, but we went pretty far down a path on a number of them. And I think what that helped us do is understand, how the Mosaic team approaches diligence, how they interact with their management teams. We got to spend a lot of time, understanding the ESOP structure, and, from a legal perspective and a governance perspective, as you mentioned, not being a control investor, which the majority of our deals are control investors, for us to understand, how you interact with the board, how the board dynamics work, what your ability is to step in and be helpful if something goes a little sideways, and we were able to also diligence through, people that have worked with you, including Salem Capital, who was our partner in this deal, who did have experience with your team, and had some experience where unfortunately a deal wasn't going quite as well as you like, and that you guys stepped in and supported that business and worked through to have a very good outcome for everybody involved. So those were all things I think were really helpful for us as a firm to spend time getting to know Mosaic, how you approached it, understanding the benefits, both, mostly benefits, also kind of what's the nuances of ESOPs that are different. And so by the time we were going down the path with New Source, most of those discussions were kind of off the table from our underwriting perspective, and it was really focused much more on the credit itself, and everything. So we very much looked at Mosaic as a traditional sponsor, a team that has a committed fund, that has capital available to support businesses, has shown that if necessary, you will make changes to the management team. That's not where you're looking to go out of the box, but occasionally it happens. And we'll also provide additional capital support businesses. And those are all the things we look for in our sponsors, is the ability to help, not just manage the business, but also understand when's the right time to step in and provide a little bit more support. So, from our perspective, as I said, we definitely viewed Mosaic very much as we do our other sponsors, and the role you guys are playing at New Source.
Excellent. Well, let's talk about New Source a little bit. So as a credit provider, and the role that you guys play on the balance sheet, what did you see when you looked at New Source? What aspects of the company did you find interesting? What were your thoughts about John and his team? And as a credit provider, what made you think that this was going to be an excellent opportunity for Stellus?
Yeah, absolutely. I think for us, a lot of times with any deal, at least I know I do, I tend to start with, kind of the industry dynamics and the macro dynamics. And do you feel good about kind of where this company is in that industry?
Yeah.
And so we spent a decent amount of time, we think that outsourcing and sort of the technology change and things that are happening here, not just in this industry, but many industries are good trend lines to support. And so, we dug in a lot on, kind of what's going on in I'll call it the banking industry, even though I know they don't just deal with banks, they go broader than just the bank world. But that automation trend line at the branches and understanding, how that's been playing out over the last number of years. When initially you hear, branches and everybody talks about, oh, wait a minute, money's going away. No one's ever using cash ever again. We were able to do a lot of research, both with your help, as well as we had some opportunities to do some back channel research through some of our contacts to really get a much better sense of saying, no, cash isn't really going anywhere. People are continue to use branches, and the banking system continues to be important, but it's changing. And this focus on, almost a tellerless branch approach is where it's going, which fits right into where NewSource is playing with the ITM space, certainly the ATM space, and things along those lines. So that was really on the macro side. We spent a lot of time and energy around that and sort of felt the tailwinds were there, along with just the white space. Even though it's happening, there is a tremendous white space of where these branches need to convert, either older branches or in some cases new ones that are replacing. So those were all beneficial. Then the other things I think we really liked about the NewSource story is once they got in the door and were able to execute on putting in the new machines, they had, I believe it's about a 95% plus attachment point to getting maintenance contracts. Yep. So a significant part of their revenue, I think it's 30% plus now, is coming off of multi-year maintenance contracts that have extremely high margins. So you look at that 30% probably drives almost 50% of the company's profitability. And it's a very, very sticky relationship. Like I said, the attachment points are really high. They really don't get canceled. So that was a huge positive to us relative to the business model, and provides a little bit of downside protection to the business. The third leg of the business that we liked a lot too, that's continued to grow, is their security business. So in addition to, as we know, the ITMs and the ATMs, the company continues to build out a focus on security, which we think is another great tailwind in the industry to see that. That also tends to be a pretty nice margin business, has continued to grow, and doesn't really necessarily correlate directly to sometimes some of the branch stuff. And so it was another nice, aspect. And I think we saw that, when, with COVID dynamics, the company in the first year or so, as you guys know, had a little bit of softness because it was really hard to get into the branches and do stuff, not because their order book was having trouble, not because the business model was having an issues. It was just strictly a byproduct of COVID. The good news is the service business did great and had great cash flow, and they continue to grow the security business. And now as we've gotten into 2022 and seen, a tick back up in the core business, it's only complementary to what they're doing.
Yeah, it's interesting, Doug. Your comments and your sort of analysis of the business and the key components to its success were exactly what we thought about internally at Mosaic. I think the only thing I would probably add is that we looked at John and his team as being proven. It's unusual for us to have the chance to work with someone who was a founder owner of a business 20 years ago and who has already had one private equity sponsor experience in their background. But we're beneficiaries of that. John and his team have done a great job. They've demonstrated, they've proven that they can grow that business effectively. They've grown it intelligently, and like you, it really always starts with management. And John and his team have done a great job so far.
Yeah, and I would agree with that. I mean, certainly we enjoyed the opportunity to get to know John and his team. In fact, I think the management meeting we attended in Minnesota in January might have been one of the first ones I went to as we kind of came out of COVID. Yeah. We felt it was important, one, to meet the team in person, get a chance to see their facility, which, there isn't really, it's not a manufacturing business, but they have a pretty interesting, setup where you can go in and see kind of a model, bank setup, and that was helpful to better understand the business. And like you, Steve, yeah, we did like the fact that John's team had been through private equity. They were, sort of a cohesive unit that had worked together, and were very knowledgeable of the industry and kind of leaders in the region that they play in. And so all those things were positive. And I think we saw that, as I mentioned before, that a little bit of softness in 21, and you had a team that, in a sponsor where nobody was kind of panicking. It was just like, hey, let's make sure we're doing the right things to manage the business. We're managing the cash flow and the profitability of it. And, a great example of how, we feel strongly about the team, what they've done, late last year, early this year, they found an interesting acquisition opportunity with your guys' help, and, a very good complementary kind of extending their Midwest geography. And, we were happy to be supportive along with Salem to help finance that acquisition, for the business, because it made a lot of sense, even though, we were still in a little bit of softness to the business, but felt it made a ton of sense to do the deal. And we had our confidence in the management team, and we're excited to provide a little bit more capital to the business to support that acquisition.
Well, that's an interesting aspect of the New Source transaction and its ongoing journey. In that when we became involved with John, he had indicated that there were always sort of opportunities on the peripheral to do a timely acquisition. I think he had done several under his previous private equity owners. And I think it's an interesting aspect to highlight that and answer a question that is sometimes asked, which is, well, gee, is being an ESOP structure going to limit or inhibit management team's ability to be aggressive and be opportunistic in terms of how they grow their business? And I think this is a great example where you and the folks at Salem played a really vital role there. Obviously, because John and his team had earned your trust as you guys have been in the transaction. But I think it checks an important box, as whether it's an outsider or whether it's an employee or whether it's an owner or manager thinking about selling their business and what the options are in terms of being employee owned. That avenue is not closed off. We've done it obviously in New Source and multiple other portfolio companies where we made sure there was capital available for management teams to continue to invest and grow their business.
Yeah, no, absolutely. I mean, as I said, we spent a lot of time over the last few years with you guys getting to understand and feel good about the ESOP structure and what it does. And I think there's, as you guys know, there's some uniqueness to it that are, pretty positive. I mean, not having control is one dynamic, but there's also, as you know, some tax benefits to the structure that have a positive impact to the cash flow. I find it interesting, for certain businesses and a lot of businesses, particularly where it's these founder owned and they want to provide opportunities for their employees to make some money and have an opportunity down the road. And this is a structure that's very appealing, to those guys. And so, I think this is a neat structure for situations where it makes sense for the management team, as well as, opportunities for the employees. And I think one of the things that we thought was interesting is that, traditional buyout, there's, hey, it's a 3 to 5 year hold and you're going to sell the business and you have to make sure that the market conditions are correct and all these other factors. The ESOP structure, while that may be an exit, a lot of the plan is it not necessarily to be a control change, but to have your exit through a financing or some other type of vehicle.
Yep.
And, I think that's, somewhat interesting to have that type of availability and another way to, exit an investment at the appropriate time. And in this case, turn it over to the employees, which is a pretty neat outcome for a company.
Yeah, I was Stellus is not recognized as an impact investor. You don't have a capital I in front of your strategy, but as a third-party lender who sees different kinds of structures, you just touched upon it. What aspect of employee ownership, how does that kind of affect or can it affect your view of a particular credit?
Well, I think one of the things in any business is you want to have alignment with everybody as much as you can,
Yep.
and that everybody interests are done in the same way. Most traditional buyout deals, you certainly have the C-suite management team incented through whether it's option pools or rolling investments or some combination of both. And that may flow itself down a layer or two depending on the deal. And we certainly find that important. I think one of the interesting things about an ESOP structure, is that layer can really go further and further down. So you have, potentially the entire employee base or a significant part of the employee base, with that incentive and alignment with the business for everybody. If the business does well, everybody's going to do well. And so in one way, shape, or form, we think that alignment of interest is really, really important, especially when you're talking about, middle market, lower middle market companies that don't have, these are not multinationals with thousands of employees. This is, hey, we've got, less than 100 employees, and we want to make sure everybody feels incented. And I think that's become, you think about the current world, everybody's aware of labor dynamics and the ability to attract labor and retain labor.
Yep.
Something like an ESOP structure, and it wasn't necessarily as a huge part of our underwriting at the time, but here we are 18 months later, 19 months later. I feel like it's even more important to have these ways that, the employees feel linked in and then retainment. And I think the company, had that historically, and has continued to see good retention, to their employee base, which is another, I think, very important aspect of the ESOP structure.
Yeah, you touched upon some of the really key aspects that we educate our management teams with as we get introduced to different kinds of opportunities. Many of the management teams, know very little, if almost nothing, about employee ownership, and we educate them on how we implement it using an ESOP. But then we also kind of educate them and enlighten them around how they can use it as an asset, as a tool to help them build their business. And you just touched upon one of the things that we talk about, which is attract, retain and incent employees in a way that really only an ESOP can do. Well, Doug, first of all, thank you for being a great partner for us and a great partner for NewSource. You guys have already played a very influential role there, helping John and his team do an acquisition. We really appreciate all the support we get from you and from Stellus. And thank you for joining our conversation today. Really appreciate it.
No, Steve, thank you for the opportunity to join. We're excited about continuing to see the NewSource growth strategy and over the next few years, and be part of it, and hopefully we might fund a few more acquisitions.
Absolutely. Thanks again, Doug.
Take care. Thanks, Steve.
Take care. See you later.
Welcome back, everyone. Well, that wraps up our quick conversations with John and with Doug. We hope that there's a couple of takeaways that you leave here with today after hearing about Mosaic, and also hearing from the key constituents in a couple of our recent transactions. First, I think is that we at Mosaic, and we think other funds who might follow our lead, are able to find great companies with great leaders that find our alternative to be really attractive and interesting. The idea that they can have the best of both worlds. They can have a traditional private equity style transaction and all the benefits that provides to sellers and to management teams. At the exact same time, they're transitioning their company into employee ownership, and allows them to begin to unlock incremental by bringing in their employees as co-owners in their businesses, and helping them unlock value in their businesses going forward. What we found, they're both lenders and leaders are attracted to an employee ownership style transaction. That being employee owned actually provides a competitive advantage to our companies going forward, that the involvement, the engagement that employee ownership can provide for great leaders allows them to further unlock value in their companies. And another component, as we look at it and we want to scale employee ownership, we want to drive ever and ever higher levels of employee owners in our companies, is that the market, we are able to convince the market that our private equity style transactions really are very, very similar to other transactions that the various constituents have participated in. So you heard from Doug that the majority of their transactions where they provide their capital is in support of traditional private equity. And yet, despite the fact that we're a little bit different in terms of how we provide our capital and what the board construct looks like, they understand that we play that role. And for them to participate them being comfortable with the role we is a key element of them to deploy their capital and allow us to be successful. Lastly, what we want to convince the market is that our transactions and our strategy really is a viable alternative. And we have just begun that journey. We have had the opportunity to interface with a wide variety of advisors and companies and leaders. And we know that is indeed true. And that we are, and so as a result, we're very excited about the future of private equity style sponsored employee ownership finance businesses. So thank you for your time today. There will be a Zoom room for hours if any of you have any questions. Obviously, we'd love to have you come and participate there, but you also have our contact information. Welcome any outreach from you at any time. If you have any questions about who we are, how we execute our transactions, the kinds of companies we're looking for, and we welcome your involvement. We appreciate your support, and we thank you for your time today.